Welcome to the Platypus September quarter update. I'm Jodie Fitzgerald, Senior Investment Specialist with Australian Unity Investments. I'm joined today by Don Williams, CIO of Platypus Asset Management. Thank you for your time, Don.
Thank you, Jodie. I'm always happy to talk about the stock market.
Don, global macro factors have had a significant influence on equity markets in recent years. What are your current observations of the global macro environment and its relevance to the Australian equity market?
Yeah, the environment is still difficult. Europe really hasn't resolved their debt issues, and as a result we'll see very low growth rates in Europe over the next couple of years. And we have an additional factor at play at the moment in that China is experiencing a slowdown that I think most people would agree is a little bit sharper than what we would have expected 12 months ago. So specifically that plays against a large sector, a large part of the Australian equity market, and that's one of the reasons that our market has underperformed in the last 12 months or so. So generally I'd say the macro is still quite difficult, especially in terms of economic growth and translation of that growth into company earnings. It's quite difficult for the majority of companies to grow in this environment.
In thinking about the performance of the Australian equity market over the next 12 months, what are the three most influential factors you're considering?
Yeah, the three major things we're thinking about today are, first and foremost, is China. How deep and how long will the slowdown in China continue for? And the reason behind that obviously is the materials sector being 25% of the Australian market. China is absolutely key for the performance of that sector, so that's right at the top of our list. The second one is trying to figure out the earnings multiple that the stock market will trade on. At the beginning of any new bull market, you get valuation expansion before you get confirmation of earnings. So a large amount of your gains in stocks will be realised before we start to get earnings upgrades. So that's the second major factor. And the third one is the Reserve Bank, where we think the Reserve Bank over the last couple of years has really lagged the economic news, whereas post the most recent rate cut, we think the Reserve Bank is now ahead of the curve, and equity investors should see the RBA as a positive influence on the direction of the stock market from here on in, we think.
You've mentioned in previous commentary that you expect fiscal year 13 to be a transition year. What do you think will be the catalyst for an upwards earning revision cycle?
That's a very good question. We've all been looking for that for the last couple of years. We think it'll be a transition year for the market in two ways. We think it'll be the year where the performance gains that we get in the next 6 to 12 months will actually be held rather than the market rolling back down to the bottom of the range. And we also think that we'll move out of this earnings downgrade period, but at the moment we would suggest that that's likely to happen in about a year's time rather than within the next 6 months.
Platypus has typically added value trading around earning surprises. What's your current view on the consensus earning numbers for fiscal year 13 and the probability of earning surprises?
The numbers for fiscal 13 are too high. The equity market's been in an earnings downgrade cycle really since the GFC, and we're not expecting that to resolve itself in the next 6 months. We're hoping we'll start to see some better numbers in the second half of fiscal 13, and then we are expecting fiscal 14 to be a much better market for positive earnings.
Where do you see the majority of opportunities for the next 12 months?
We expect the majority of opportunities to come from the smaller names in the market, so the mid-cap names and the X100 names. We don't expect good returns from the large mining companies, and we're only looking for a modest total return from the major banks and other large companies. So over the last 6 months, a lot of the X100 names that have had very good business models that have traded very well in a tough environment have performed very well. So in the Platypus portfolio, companies like Domino's, Car Sales and Certex are good examples of that. So we think there are a number of those types of companies in the market that will continue to perform well regardless of how poor the macro is, and we still see good returns from those names.
Thank you for your time, Don.
Thank you, Jodie.